All right, so ESR-REIT just released their latest annual results. And if you're an investor, there's really only one number you need to see first. We're going to unpack what that number is, what's behind it, and what it all means for this absolute giant in industrial real estate. So let's dive right in.
And there it is. That's the number that matters most, plus 7.6%. This is the growth in their core distribution per unit, or DPU for short. It's the headline, it's what investors watch, and it's a really solid number. Now, you might be wondering, what exactly is a DPU? Let's break that down.
So, a DPU is super simple. Think of it just like a dividend you'd get from a stock. It's the cash payout you, the investor, receive for every single unit of the REIT you own. So, when we see that 7.6% jump, it literally means more cold hard cash flowing back to investors from the company's day-to-day business. Pretty great, right? Okay, so the big story here is clear. Investor payouts are up. But a nearly 8% increase in cash distributions doesn't just happen by magic. It has to be fueled by something real. So the big question is, where did all that extra cash come from?
Well, here's your answer. Just look at this massive jump in their top-line revenue. We're talking about going from about 370 million all the way up to 446 million Singapore dollars. That's a leap of over 20% in a single year. This is the engine that's powering those bigger payouts.
But of course, a number like 20% revenue growth is just a figure on a spreadsheet. What does it actually represent? So let's pull back the curtain and look at the real-world assets and operations that made it happen. And what's really interesting here is that this growth wasn't just a one-trick pony. They were firing on all cylinders. They were getting more money out of the properties they already owned, plus they got a huge boost from a couple of key acquisitions that really started to pay off, especially the ESR Yatumi Kisosaki Distribution Center and 20 Tuas South Avenue 14.
And this image right here gives you a perfect idea of the kinds of properties we're talking about. Look, these are not your grandfather's old dusty warehouses. ESR-REIT is all in on what's called new economy assets. We're talking about high-tech logistics centers, modern industrial facilities, maybe even data centers. Basically, the physical backbone that makes things like e-commerce and the digital world actually work. These are the properties that are in super high demand, and they are the absolute engine of this REIT's income. So that's the story of the past year. Solid performance, great assets, but as any investor knows, that was yesterday. The real question is always, that's great, but what are you going to do for me next? So let's take a look at their game plan for the future. And their strategy is refreshingly straightforward. It's built on three main pillars. First, keep improving the portfolio. Buy more of the good stuff and get rid of the older assets. Second, be smart with your money. Keep debt levels, what they call gearing, in a really sensible, safe range. And third, start looking for smart opportunities to expand into other developed countries.
Now, on that point of expansion, this is where ESR-REIT has a superpower. They're not just some standalone company. They are backed by the ESR Group, an absolute titan in the Asia-Pacific real estate world that manages $75 billion in assets. This is a total game changer. It means they get access to deals others don't, they get better terms on loans, and they have a level of market intelligence that is just, well, it's a massive competitive advantage. But of course, having a great plan and a powerful backer is one thing. Executing it in the real world is another. Let's be real, no investment is a sure thing. So now we've got to take a balanced look at what's ahead, weighing the really big opportunities against the potential risks on the horizon.
Okay, so let's break it down. On the opportunity side, you've got that incredible sponsor, a laser focus on those hot new economy assets, and a clear plan to sell older properties to fund new growth. But on the other side of the coin, there are things to watch out for. They still have some older assets to deal with. And then there's the big stuff that's out of their control, like the general health of the economy and the elephant in every room right now, changes in interest rates. All right, we have covered a ton of ground here, from the nitty-gritty of their financials all the way to their big picture strategy. So let's boil it all down. What are the key takeaways you as an investor should walk away with? So here's the bottom line. First, that payout to investors is growing at a really healthy clip. Second, that growth is being paid for by real, strong revenue growth from the right kind of high-quality properties. Third, the management team has a clear, sensible plan for the future. And finally, and you can't overstate this, having a heavyweight sponsor like ESR in your corner is a massive, massive strength.
Which really leaves us with this one central question. They seem to have everything going for them. The right assets, a clear strategy, a powerful sponsor. The results speak for themselves. But is all that enough to fight back against those bigger economic headwinds, like rising interest rates?
The case for the company is strong, but the risks are definitely real. And that's the ultimate question you have to ask. Do the opportunities here outweigh those risks?
This content is intended to serve strictly and only as an informational, independent, objective summary of recent events and should in no way be interpreted, construed, or relied upon by any party as inside information or financial advice.